All right, let's dive in. Looks like someone is ready to get their hands dirty with some financial shenanigans. Am I right? A whole stack of material here. And front and center, we've got Howard M. Shillett himself, Financial Shenanigans, 4th edition.
Can't go wrong with a classic.
Yeah.
Shillett's been at this, exposing these tricks for over 25 years. And this edition, it's packed with new examples, fresh insights, the whole works.
So what's the mission for this deep dive? I'm seeing a theme here, and you want to understand how companies, how they pull the wool over investors' eyes. The different techniques, right? What makes them tick. And the big one, how to spot those red flags, like developing, financial X-ray vision.
You got it. We'll be your guides through this maze of creative accounting, shall we say. Shillett, he breaks down these financial shenanigans into 4 main groups. You've got earnings manipulation, cash flow manipulation, then there's manipulating key metrics, and of course the shenanigans that come with all those acquisitions. Each one designed to distort, well, the real picture of a company's finances.
Okay, so let's jump right in. The book opens with 25 years of shenanigans, and some of these stories are, well, pretty wild. Take West Communications, for example. Their CEO, Joe Nocchio.
Oh, Nocchio.
Yeah.
He was fixated on those earnings targets, absolutely obsessed. I think he even said something like, everything stops when we don't make the numbers. That kind of pressure cooker, where hitting a specific number is everything, well, it can lead to some really, really bad choices.
And that's exactly what happened, right? Quest ended up in a $2.5 billion accounting fraud, all to make it look like they were hitting those targets. Makes you wonder, though, where were the auditors in all of this?
Ah, yes. The gatekeepers, even the big auditing firms, the reputable ones, they can miss these things sometimes. Or, sometimes they maybe look the other way. Take the waste management scandal, for instance. Arthur Anderson, their auditor, they knew about some accounting issues, but get this, they called them immaterial.
Immaterial. That's a bold move, considering those immaterial issues turn into a massive accounting fraud. Really highlights why it's so important. That skeptical, that forensic mindset, right, for any investor, wouldn't you say?
Absolutely. You can't just take the numbers at face value. You got to dig, ask those tough questions, look for the inconsistencies. Speaking of which, let's move on to our first category, shall we? Earnings manipulation. This is where companies try to make their profits look better, well, better than they actually are.
And a classic move there is recording revenue too soon, right? Shillett calls it bringing sales forward. It's like squeezing, I don't know, a whole week's worth of sales into a single month, kind of like what Computer Associates did back in the day.
Ah, yes. The infamous 35-day month. Computer Associates, they stretched their fiscal month just to book more sales, make their growth look stronger than it really was. A prime example of how timing, that revenue recognition, can be manipulated.
And it's not just about messing with the calendar, right? You've got those bill and hold sales where they bill customers for products before they're even, well, shipped, or shipping unfinished products just to boost that reported revenue.
Creating that illusion of a done deal, a completed sale, even if the actual transaction, well, let's just say it might not be entirely above board. And these tactics, they can get pretty creative. Remember that Krispy Kreme case?
Oh, yeah, the one where they shipped equipment to company-owned trailers and the franchisees couldn't even access them. It's almost funny, but it also shows just how far some companies will go to pump up their earnings.
And that's where that forensic mindset comes in, right? As an investor, you got to ask yourself, does this revenue recognition make sense? Any red flags popping up? Are they using some kind of, well, unusual accounting practices?
It's all about looking past the headlines, understanding the nitty-gritty of how a company is actually generating its revenue. But, okay, recording revenue too soon, that's just one type of earnings manipulation, right? What about those companies that go a step further and record, well, totally bogus revenue?
Yes.
Yeah.
Not just timing anymore. It's about conjuring revenue out of thin air. Shillett gives this great example. Brightpoint, a cell phone distributor, they cooked up this scheme with AIG, created fake insurance to hide their losses. It was basically a loan dressed up as an insurance policy.
And Peregrine Systems, the software company, they did something similar, right? Recorded revenue from non-binding software licenses, and they had these secret side agreements that basically waived the whole payment obligation.
Okay.
So they were booking revenue that they knew they'd never collect.
Exactly. Creating this facade of revenue generation, even when the underlying transaction, well, it's just empty. This is where understanding the business, the industry, it really comes in handy. If a company's revenue growth seems too good to be true, well, it probably is.
So we've seen how companies can inflate their earnings, bringing those sales forward, creating bogus revenue out of thin air. Any other tricks up their sleeve?
Oh, plenty. Another favorite is shifting expenses, pushing them off to a later period, kind of like sweeping dirt under the rug, you know. It might look clean on the surface, but all that dirt, it's still there, just hidden from view.
And how do they pull that off? Shillett mentions something called the Texas two-step.
He does. First step, they capitalize expenses that really they should be recognizing right away. So instead of expensing a cost immediately, they treat it as an asset, put it on the balance sheet, spread that expense out over a few years. WorldCom and their capitalization of line costs, that's a classic example.
Right. So they basically turned, what, billions of dollars of expenses into assets, making their profits look way bigger than they actually were. And the second step of this Texas two-step.
That's where they bring in those restructuring charges and cookie jar reserves. They take this big one-time charge to clean up their books, creating this illusion of, well, future profitability.
So, sacrifice short-term earnings to paint a rosier picture down the line. Sounds like a shell game, moving those expenses around to make the numbers dance. But how about shifting income to a later period? Isn't that, well, the opposite of recording revenue too soon?
It is. Instead of pulling future revenue into the present, they're pushing current income into the future. They do this by creating reserves, hiding those current earnings, then releasing them later to smooth out any fluctuations or, to give those future profits a little boost. Remember Microsoft and all that unearned revenue?
Vaguely. Didn't they defer revenue from software sales, even though they had already delivered the product?
That's the one. It's like saying, okay, we earn this money, but we're going to hold on to it for a bit, save it for a rainy day. And of course, that rainy day conveniently arrives when they need a little help hitting those earnings targets.
Okay, so we've covered 4 ways companies can manipulate those earnings. But earnings, that's just one piece of the puzzle, right? What about cash flow? Can they play games with that too?
Oh, you bet they can. Cash flow shenanigans, they're all about creating this misleading picture of how much cash a company is actually generating. Schlitt, he lays out 3 main categories: shifting financing cash inflows to the operating section, then shifting operating cash outflows to the investing section, and finally, shifting operating cash outflows off the statement of cash flows altogether.
All right, let's break that down a bit. What does it mean to shift financing cash inflows to the operating section?
Basically, it's about making that operating cash flow look healthier than it really is. They do this by disguising loans as operating activities. Take Delphi, the auto parts supplier. They sold inventory to Bank One, agreed to buy it back later, all to make their cash flow from operations look better.
So basically taking out a loan but dressing it up as an operating activity. Pretty sneaky. What about selling receivables? Isn't that a legitimate business practice?
It can be, but it could also be a way to manipulate that cash flow. Shillett warns about companies faking the sale of receivables, all to inflate their cash flow from operations. Remember Peregrine Systems.
Ah, yes, the software company with the bogus revenue. They use this trick too, huh? To hide their true financial picture. Sounds like they were busy.
They were. A classic example of how a single company can use multiple shenanigans at once to paint a completely distorted picture of how they're actually performing.
Okay, so shifting those financing inflows to operations, one way to mess with cash flow. What about shifting operating outflows to the investing section?
Another sneaky tactic. Companies, they try to make their operating cash flow look better by classifying normal operating expenses as investing activities.
Shillett uses Global Crossing as an example, the telecom company that engaged in those boomerang transactions, selling future capacity for cash, then simultaneously buying back capacity from those same customers. What's the impact of that?
It artificially inflates their cash flow from operations. It's like generating cash without actually creating any real economic value. Think of it like borrowing from your future self to make your present look a bit more impressive.
Not exactly a sustainable strategy. And then there's the case of Netflix, right? They categorize those DVD purchases as an investing outflow, unlike Blockbuster, who treated them as operating outflows.
Right, even though both companies were essentially doing the same thing, buying DVDs to rent them out. Shows how those accounting choices, they can paint very different pictures of a company's, financial health.
So what about the last category? Shifting operating cash outflows off the statement of cash flows entirely. How do they even manage that?
This is where things get creative. They might stretch out their payables, delaying paying their suppliers to hold onto cash, or they might accelerate their collections, squeezing their customers to pay those invoices a bit faster.
So it's all about manipulating that timing, the timing of cash inflows and outflows to make that cash flow look better than it actually is.
Shillett brings up Home Depot under Bob Nardelli as an example, right? Exactly. Nardelli, he stretched vendor payments and reduced inventory, all to, well, artificially boost that cash flow in his first year. Made his performance look impressive, but it also put a strain on their relationships with their suppliers.
So to recap, cash flow shenanigans, it's all about creating this misleading picture of a company's cash generation. But cash flow, earnings, those are just two pieces of the puzzle.
Right.
How do these shenanigans affect those key metrics that investors use to evaluate companies?
That's the million-dollar question, and it leads us perfectly into the next section.
Yep.
Key metric shenanigans. Now, this is where things get really interesting.
Because companies are always coming up with new and improved metrics to highlight their performance, but are they always what they seem?
Not always. Remember, what gets measured gets managed. And if you're measuring the wrong things or manipulating those metrics, well, you're likely to end up with a pretty distorted view of reality.
Okay, so let's dig into some specifics here. How do companies manipulate those key metrics? Shillett, he breaks it down into three main areas: misleading revenue metrics, misleading earnings metrics, and misleading cash flow metrics. Let's start with revenue. What are some examples of misleading revenue metrics?
Well, think about same-store sales, for instance. Often used in retail to track growth, right? But it can be manipulated by closing underperforming stores or opening new ones in strategic locations.
So they're cherry-picking the data to present a more favorable picture, like showing off your best side in a photo, but conveniently cropping out those unflattering angles.
Exactly. And then there's the manipulation of bookings and backlog to make future revenue look stronger than it really is.
What about misleading earnings metrics? We hear a lot about non-GAAP earnings these days. Is that something to be wary of?
Absolutely. Non-GAAP earnings like EBITDA and adjusted earnings, they can be useful sometimes, but they're also easily manipulated to exclude recurring costs and make those profits look bigger than they actually are.
Shillett talks about Groupon and their Consolidated Segment Operating Income, or CSOI. It was this misleading metric used to hide losses. Seems like they were trying to redefine profitability to suit their own needs.
Exactly. It's a reminder that you always need to understand how a company defines and calculates its metrics. Don't just take their word for it. Dig into those footnotes, see what they're including and excluding.
Okay, and finally, what about misleading cash flow metrics? What should we be on the lookout for there?
One common tactic is manipulating days sales outstanding, or DSO. Measures how long it takes a company to collect its receivables. Companies can manipulate DSO by, reclassifying receivables or using different calculation methods to hide collection problems.
And then there's the classic inventory manipulation. Shillett talks about tween brands. They invented this new in-store inventory metric to downplay concerns about their overall inventory buildup. It's like rearranging the deck chairs on the Titanic.
It is. They're trying to distract you with this shiny new metric. While the real problem, it's still there, lurking beneath the surface. Highlights the importance of, not just accepting those new metrics at face value. You need to understand what they're measuring, how they're calculated, and whether they truly reflect the reality of the business.
Okay, so we've covered earnings manipulation, cash flow shenanigans, and key metric shenanigans, which brings us to our final section, acquisition accounting shenanigans. Shillett kicks it off by highlighting the reasons why acquisitions, why they so often fail.
He nails down three main culprits: overconfidence in synergies, then those reckless deals driven by fear or greed, and lastly, deals that are motivated by accounting benefits, not by, sound business logic.
He uses the example of United Airlines trying to create this travel conglomerate by acquiring Hertz and hotel chains, classic case of overreach and trying to do too much too quickly. And then there's the story of Mattel and their disastrous acquisition of the Learning Company, highlighting the risks of acquiring companies with a history of, aggressive accounting.
Which, as we've seen, is definitely something to watch out for. But how can companies use acquisitions to create these financial shenanigans?
That's a great question. And it gets to the heart of this section. It's about understanding how the accounting for acquisitions, it can be used to mask a company's true financial performance.
Exactly. Companies can use acquisitions to inflate their cash flow from operations, even if the acquired business isn't actually doing well. They can manipulate working capital, exploit accounting rules to further enhance that cash flow from operations through acquisitions. It's a way to hide those underlying problems and create this illusion of growth and profitability.
And Shillett specifically warns about acquisitions from private equity firms, right?
He does. because their focus is often on short-term gains, financial engineering, not on building sustainable businesses. They might load up a company with debt, strip out the assets, and then flip it for a quick profit.
Valiant Pharmaceuticals, perfect example of what can go wrong when a company relies too heavily on acquisitions for growth and, well, and engages in those questionable accounting practices.
Absolutely. Their aggressive acquisition spree, coupled with aggressive accounting, it ultimately led to their downfall. A cautionary tale, for sure.
So if we're looking at a company that's been making a lot of acquisitions, what are some red flags? What should we be watching out for?
Well, a history of accounting problems at the acquired company, that's a big one. You also want to watch for a sudden surge in sales or earnings right before that acquisition, as well as a lack of transparency about the details of the deal itself.
And what about the purchase price allocation?
Crucial. Scrutinize how that purchase price is allocated to different assets and liabilities. Watch out for any signs of inflated intangible assets, because that can be a way to hide future expenses and boost earnings.
Another red flag when a company changes its accounting policies after an acquisition, to make those numbers look a bit better.
Right, like we saw with Valent and Medici's. They changed the revenue recognition policies to boost those reported sales.
So it all comes down to being skeptical, asking those tough questions, digging into the details.
Exactly. Don't just believe the hype. Look at the track record, understand the motives, and dig into that accounting to see if the story actually holds up.
This has been an incredible deep dive into some of the most common financial shenanigans. We've covered a lot of ground, from manipulating earnings, manipulating cash flow, to playing those games with acquisitions. But before we move on, let's take a moment to reflect on what we've learned so far.
That's a good idea. We've thrown a lot of information at you. It's important to pause and let it sink in.
So you, the listener, you've been taking notes, right? We're starting to build that forensic mindset. But remember, this is just the beginning. There's so much more to explore. We'll back in a moment to continue our deep dive into the world of financial shenanigans. Stay tuned. And we're back. We've been digging into some pretty sneaky financial shenanigans, right? From manipulating earnings, cash flow, to using those acquisitions as a smokescreen. But I'm getting the feeling this is just the tip of the iceberg, right?
Oh, it is. And that's why in his book, Sheila dedicates that last chapter to developing what he calls the forensic mindset. It's about arming yourself, giving you the tools, the knowledge to cut through that financial fog and make those smart investment decisions.
All right, I like it. Tell me more about this forensic mindset. Is this something, I don't know, are we born with it, or can we learn it?
It's definitely a skill you can develop, yeah.
Yeah.
And Sheila, he lays out 10 key principles, kind of like a roadmap to guide you along the way. The first one, he says, skepticism is a competitive advantage. He argues that in finance, in this world, being a bit of a cynic, it can actually work to your advantage.
So it's about questioning those assumptions, not just taking things at face value, always looking for potential problems. Basically, don't be afraid to channel your inner detective.
Exactly.
Yeah.
And that leads us to the second principle, which is pay close attention to changes. Always ask why and why now. Companies, they don't just change their accounting policies, their key metrics, their business strategies out of the blue, right?
Yeah.
There's a reason, and sometimes that reason, well, it might not be so innocent.
Okay, so if a company suddenly starts emphasizing a new metric or changes how they recognize revenue, that's a red flag. We got to be asking ourselves, what are they trying to hide here? Or what are they trying to distract us from?
You got it. And that ties right into Shillet's third principle. Look past accounting problems to see if business problems are being covered up. Sometimes those accounting shenanigans, they're just a symptom of, well, deeper issues within the business itself.
So the accounting, it might be technically correct, but it's masking a bigger problem, right? With the company's operations, their strategy, their competitive position.
Exactly. And that's why it's so important to look beyond those numbers, Understand the company's business model, the industry they're in, and their competitive landscape.
All right, so we've got skepticism, looking for those changes, digging deeper into the business. What else should we be paying attention to?
Shillet's fourth principle is pay attention to corporate culture and watch for breeding grounds of bad behavior. He says that companies with weak corporate governance, a culture of fear, or too much pressure to meet those targets, they're more likely to engage in those financial shenanigans.
Makes sense. So if a company has a history of accounting scandals, or their executives are known for being, I don't know, ruthless, cutthroat, that's a warning sign. Like that's saying, where there's smoke, there's fire.
Exactly. The fifth principle, he says, never blindly adopt the company's profitability framework. It's about understanding how they define profitability, how they measure it, and whether those metrics are they actually reflecting the true economics of the business.
We talked about this earlier, right, with those non-GAAP earnings. Companies can, well, they can manipulate their definitions of profitability to make themselves look better.
Right. Always be careful with companies that use a lot of those non-standard metrics or adjust their earnings in ways that seem, well, aggressive or unusual.
Principle number 6, incentives matter. Pay close attention to how executives are compensated. Makes sense, right? If executives are rewarded for hitting those short-term targets, they're more likely to, well, cut corners to get there.
For sure. Look at their compensation plans. See how they're incentivized. Are their bonuses tied to earnings growth, stock price, what?
So if a company's compensation structure, it incentivizes that short-term thinking, that's a red flag. Suggests that management might be more focused on hitting their numbers than on building a sustainable business for the long run.
Shillit's 7th principle is even in financial disclosures, location, location, location. He points out that companies often bury important information, hiding it in the footnotes, those obscure sections of their filings, hoping investors won't notice.
So it's not enough to just glance at the headlines, right? Got to dig into those footnotes, the MD&A, all those other, well, less glamorous parts of those financial statements.
That's where it's at. The devil's in the details, as they say. And that's where you'll often find the real story.
Principle number 8, like in golf, every shot counts. What does he mean by that?
It's a reminder that even those small accounting adjustments, they can add up, has a huge impact on earnings. Companies might downplay them, but you got to pay attention to that cumulative effect.
So we can't let those seemingly small details slip through the cracks. It's about seeing that big picture, understanding how all those pieces fit together.
Principle number 9 is patterns of behavior provide a reliable signal. Shillett says that companies that engage in these shenanigans, they often have certain patterns of behavior.
Like repeatedly changing accounting policies, using those aggressive revenue recognition practices, or making acquisitions to cover up weak organic growth. So we need to look at their track record, see if they have a history of playing fast and loose with the rules.
Right. If you see a pattern of, well, questionable behavior, it's a pretty good indicator that something might be off. And finally, principle number 10, don't be afraid to walk away.
If you're seeing too many red flags, don't be afraid to sell those shares, even if it means taking a loss. It's better to protect your capital than to go down with the ship. Really important point this. Sometimes the best investment is no investment at all.
You got it. It's knowing when to fold them and move on.
So there you have it. Shillett's 10 principles for developing that forensic mindset. It's being skeptical, asking the tough questions, digging into the details, and the big one, not being afraid to walk away if something feels off.
It's a powerful framework for sure. Analyzing companies, making smart decisions. But remember, it's an ongoing process. This world of finance is constantly changing, and those creative shenanigans, they're always popping up.
So we got to stay vigilant, stay informed, stay ahead of the game. This deep dive, it's been incredibly informative. We've covered those 4 main categories of financial shenanigans and Shillett's 10 principles for developing that forensic mindset. So what does this all mean for you, the listener?
It means you're armed now. You've got the knowledge to spot these tricks to protect your investments.
We've taken a deep dive into this world of financial shenanigans, but there's always more to learn, right?
Oh, absolutely. The world of finance is constantly changing, and those creative shenanigans, they're always popping up.
But the good news is the basic principles, the principles of forensic accounting, those stay the same.
By staying informed, asking the tough questions, and keeping that healthy skepticism, you could stay ahead of the game, avoid being caught off guard.
Great point. This deep dive has been, incredibly informative, but I have a feeling there's one more takeaway, one more key takeaway that we haven't really discussed yet.
You're right. We talked about recognizing those shenanigans, the importance of that mindset, but what about prevention?
That's it. What can we do to stop these shenanigans from happening in the first place?
That's the question, isn't it? And while there's no easy answer, no magic bullet, there are a few things we can do to create a more transparent, a more accountable corporate environment. Shillett, he briefly touches on this, the importance of checks and balances in corporate governance.
Right. A strong board of directors, an independent board, one that's willing to challenge management, that's essential. But what about the auditors? They're supposed to be the gatekeepers, right?
They are, and they play a critical role in making sure those financial statements are accurate. But as we've seen in some of these examples, Auditors, well, they don't always catch everything.
So what can we do to improve that audit process?
Shillett suggests strengthening auditor independence, increasing auditor skepticism, and enhancing their expertise. We need auditors who aren't afraid to ask those tough questions, who have the knowledge, the experience to spot those complex accounting schemes. But it's not just about the auditors, the boards. Regulators, they play a key role, too, in preventing these shenanigans.
The SEC, for example. They've been stepping up their enforcement, right, in recent years.
They have. And they've also been working on improving those accounting standards, the disclosure requirements.
But at the end of the day, preventing these shenanigans, it takes a collective effort, doesn't it? Creating a culture of transparency, accountability, where everyone involved in that financial reporting process, they're committed to upholding those ethical standards.
Investors, analysts, auditors, board members, regulators, everyone needs to work together to create a system that's more resistant to these manipulations.
It's a challenge, but a challenge worth taking on. Because, well, the integrity of our entire financial system depends on it.
Powerful message to end on.
It really has been a fascinating deep dive into this world of financial shenanigans.
It has. And while it can seem like a daunting topic, understanding these tactics, it's so crucial for anyone who wants to be a successful investor.
We've covered a lot of ground today, but we'll be back next time with another deep dive into a new and intriguing topic.
Until then, stay skeptical, stay curious, and keep those forensic minds sharp.